Hi, so today we're going to look at different investments because most people think having a diversified portfolio means owning a lot of different things. No, it means owning things that move differently, that do not move in tandem. And today I'm going to show you exactly what that means with a live simulation, which you can also run at home. All right, we're at the desk. So we're going to first look at each asset individually and then some other cases, like for example, a portfolio made up of different percentages of each of the other investments. So let's jump right in. Here we have the simulation. These are Monte Carlo simulated, meaning that based upon specific assumptions and using geometric Brownian motion. Doesn't matter what that is specifically right now, but it basically pretty accurately, based upon the assumptions, simulates the movements slash path of investments. And if we click on the run simulation button a few more times, we see that there's different outcomes each time because we basically simulate 200 of these paths per investment. And then we take the middle of that, the median, which is less sensitive to extreme outcomes like the mean, which is more sensitive to those. Okay, maybe this is already exciting. We can see for, let's say, 5 years, the outcome. We can zoom in and then we see, okay, savings a bit above inflation. Then we have bonds, gold, the S&P 500, portfolio, a quant SMA, and then up here, Bitcoin. Okay, well, then we also have some stuff to simulate or visualize risk. For example, the 25th and 75th percentile, meaning the basically outcomes up to the extremes of 25% on each side. So the 25% most extreme outcomes on each side are excluded. And then we really have to zoom in to see anything at all because the extreme events for Bitcoin really skew the chart here. Everything is overlapping, so that shows the uncertainty that we have with these things always. Then let's look at the savings account, which is sort of for a lot of people, especially I guess in Western Europe and Germany, the default option for where to park their money, basically, perhaps grow it a bit. So this is the nominal value. At the end of 5 years, we have approximately in the median 116,000. So that means 16% return over 5 years from 100,000. We always start at 100,000 here. And over 20 years, the median is 34% return, $134,000. However, when we adjust it by inflation, meaning we subtract what the purchasing power that inflation would eat away at it, then even after 20 years, we only have a gain of 5%. So only a 5% return after 20 years. In 30 years, this is the median, as I said, it's only 7%. We can include some percentile bands, for example, 25 to 75, and then we really have to zoom in because there's not a lot of variance. It's all around 6.5 to 8 point something percent return after 30 years. It's a long time and not a lot of return. Of course, with each of these investments, you have to keep in mind what is their purpose. And with a good diversified portfolio, it's of course to diversify. So a savings account might be sort of for cash money that might be needed soon or at some point. There's savings accounts where you can deduct money not just after, there's basically not strict lock-up periods, but you can deduct the money much more quickly. And but yeah, let's move on to the next investment. Let's look at the classics of bonds and then stocks. By the way, going forward, we're always going to look at real values, meaning inflation adjusted. So you don't have to worry about that. The baseline, as you can see here, the dashed line, that is adjusted for inflation basically. So if something is below that, after inflation, after counting in inflation, it's a loss. Okay, so bonds, right? Very low volatility, safe, but also because of that, lower return. You're rewarded with less return because it's less risky. But it shows because after these simulations, you can see that the volatility, the drawdowns are not very high. Let's include the percentile bands, the inner percentile bands, basically. And then we can see that the variance after 30 years is between 20% return and around 190, also 90% return. So this sort of is a low volatility, low risk, but also lower return investment. And then just to give you a visualization on the same chart, same simulation, I just clicked to show also the S&P 500, which I will use as a proxy for stocks, for equities. And look at how extreme the chart now looks with, I have to scroll or pan up so much to see the end result with stocks. So I'll reset the zoom and only show the median, not the percentile bands. And what we see is, of course, in this chart, because it has to be much more compressed of what we see for bonds, because stocks just go so much higher, so there's less detail. But you can just see how little volatility there is in this simulated case. But we can also see that stocks go much higher, and this is basically the benchmark that everything is measured against. Of course, like 100 plus years of crises, wars, inflation, but the S&P 500 and stocks are still generally up and to the right. So basically just trending upward as time goes on. And but yeah, let's look at some risk visualizations. So first the inner percentile bands. The lower bound, so to speak, is 4x after 30 years. But let's look at some shorter time horizons. When I click here, it always reruns all of the simulations. So the lower bound after 10 years is basically 50% return. And then the upper bound is 3x. But the median is 2.2x. And this shows that there's more volatility, more uncertainty with stocks, but also, it can be sort of assumed, but of course not guaranteed, that there's a high return. All right, the next one is gold. And now we come to the juicy part of diversification, because in general, the compound annual growth rate, CAGR, is sort of comparable to equities, to stocks, to an index fund, but it's very low correlation to stocks. So that means it fits really well in a diversified portfolio. And we can look at the 10-year time frame. If I just run it a few more times, it's always around 140, 160 thousand at the end of 10 years. So 40, 50, 60% return. Then if I show the inner percentile bands, it's between 18% return and 2.2x. So more volatility. Of course, this is all based on assumptions, but these assumptions are, in my opinion, very realistic, but you can always also just download the HTML file and adjust it yourself. All right, and the next one is managed quant trading. SMA means separately managed account. So this is someone doing quant trading for you. As I said, these are all investments. And on a 10-year horizon, the median is 4.5x. And if I show the inner percentile bands, it's between 3.5x and 6 point something x. So very high, and over 20 years, much higher, 30 years, very, very high. So even 5 years, the median is about doubling the initial investment. However, of course, this assumes that the returns and drawdowns and so on stay about the same. They're robust, they are systematic, and the manager doesn't lose their edge. And this is basically what we do at AutoTrade Lab. And you might be wondering, aren't we missing something? Yes, I will cover Bitcoin soon in a separate segment. Here we have the S&P 500 and Bitcoin, and the 50th percentile line, the median, is what the typical investor can expect with an investment. However, notice how, for example, with Bitcoin, the 25th and 75th percentile bands are so wide. It's extreme. Compare this to the S&P 500, right? If I zoom in to be able to see the S&P 500 bands properly, it's no comparison. For example, I mean, I will switch to logarithmic so we can properly look at Bitcoin here over at the 5-year end. But the bands of the S&P 500 seem to be, just between 100K and 200K. So basically strictly above with these simulation paths the initial investment, however very close together. And then with Bitcoin, the band starts at, or the lower band, so to speak, is at 70,000, but the upper band is at 1.5 million. And now let's look at an even more extreme example with the band between the 1st and 99th percentile and the band between the 5th and 95th percentile. It's a bit hard to make out perhaps, but for Bitcoin, the very, very widest tails are at 700 billion after 30 years and at $100. So either basically Bitcoin rises into the sky or it tanks completely to zero. And that just shows how with Bitcoin, the outcome is highly path dependent. These statistics are all nice, these simulations are nice. However, basically the real world outcome will be one of these paths, and we don't know which path it is. Of course, if we look at this distribution and we take the median, it's probably going to be closer to the median than the tail, but we can't say for sure where it's going to land. And that is the risk and uncertainty that you have with specific investments. All right, and let's now look at Bitcoin specifically, because it's a very special case. We're modeling with this chart, for example, Bitcoin's paths with the power law, meaning that returns continually decline, which is actually the case in real life in early years and up until recently, the compound annual growth rate was around 40%. So if I disable the power law here, the button, and run the simulation again, we can see an extremely different outcome. I'll switch to linear charting so you can actually see the difference. For example, with this simulation, the median is at 35 million with an initial investment of 100K after 20 years. With this one, the median is at 100 million. With this one, the median is at 70 million. But if I enable the power law, that means that the annual rate of return scales down over time. Every year you get a lower rate of return. Then after the same amount of time, the median is at 4 million. In this case, 1.4 million, 3 million. And that is much more realistic with Bitcoin. We will probably not see that Bitcoin holds these, annual growth rates as it has in the, so to speak, early years. And what we're going to probably see is more of a power law decline of its returns. And now comes the juicy part, which are the baked in correlations that I've baked into the simulation underlying what you just saw, the charts. So here we have the table of how these investments are correlated with each other. So for example, the S&P 500 and bonds have a negative correlation of 0.2. That means that if one goes up, the other goes down, which simulates basically the flight to safety, that if you have a crash or downturn in stocks, usually people flee to the safer government bonds. Similarly, with the S&P 500 and Bitcoin, for example, and same with quant trading, is what you could describe as a risk-on sentiment. If there's general positive market sentiment of investing in riskier assets, for example, I guess tech stocks, then they might also invest in Bitcoin or quant trading. And that brings me to the next point, which is about the portfolio. I haven't talked about the portfolio yet. So this is basically made up of the other investments. The standard is stocks 30%, bonds 20%, Bitcoin and gold 10%, savings 5% for cash, and quant trading 25%. And this is real balanced in this simulation annually, but it doesn't really make that big of a difference for this simulation. And if we look at the chart, we see that although the portfolio has exposure to Bitcoin and it inherits some of the volatility, it's not nearly as volatile. I don't want to say that this is representative or what it would be in real life. If we run it again, Bitcoin lands significantly higher here as well. However, what we can see is that the portfolio is higher than, of course, a savings account, but also bonds, gold, the S&P 500 in blue, and then very close to quant trading, assuming this very robust, consistent trading over many years. So higher than the less risky assets, closer to the, so to speak, more risky investments, but with less volatility. And this is what a diversified portfolio looks like. So we see that with gaining exposure to higher return, but also higher risk assets, the portfolio's mean is, we're at the end of 20 years now, we're looking at the last 5 years, significantly higher than definitely savings, but also bonds, gold, and stocks. And this is because we gain the exposure to the returns of quant trading and Bitcoin without necessarily all of the volatility and risk. So we can also look at quant trading and Bitcoin. And if we look at the bands, if we look at the percentile bands, let's look at the 25th, between 25th and 75th percentiles, then Bitcoin's range is insane. So let's not look at that for now. But what we can see is that the range, the band basically between the 25th and 75th percentile for the portfolio is also still strictly higher than the investments into the S&P 500 and bonds, meaning it is overall in this simulation higher. However, it does not inherit the extreme uncertainty and the extreme risk of, for example, Bitcoin. Let's look at Bitcoin and the portfolio. So we see that Bitcoin is here below, at the lowest, at the lower bound, is below the initial investment after adjusting for inflation, but the upper bound is very extreme. So these are the few paths that go very, very high. 30 million there. However, a lot of these paths also have gigantic drawdowns with Bitcoin. So, I mean, also in real life, of course, minus 60%, minus 80%. And it's always a psychological stress. Maybe strictly speaking, if you invest 100% of your portfolio into Bitcoin, you will at the end of specific time periods like 10, 20, 30 years have more money. However, the psychological stress of living through those drawdowns will be extreme, and a lot of people can't handle it. Let's look at some more conservative portfolios. For example, a portfolio with 30% in savings and then 35% each in bonds and the S&P 500. This is not really the classic 60-40 portfolio of 60% in stocks and 40% in bonds. However, it illustrates a more risk-averse investor, so to speak. And this is a simulation for 10 years. Okay, 10 years, that's a long time, that's a decade. And at the end of the 10 years, the median for the portfolio is a 37% return. Stocks 67% and bonds 21%. However, let's adjust it for inflation. And then the portfolio's return is 18%. Bonds return only 5%. And the S&P 500 stocks 44%. And of course, the portfolio looks very low volatility, probably has a high Sharpe ratio, because the Sharpe ratio also punishes volatility on the upside. However, it's not moving up a lot. You know, this is all, of course, subjective, and it's low risk, so it has that going for it. However, by balancing high return, high risk assets with lower risk but lower return assets, you can get a nice mix of these things. Look, I'm not telling you what to buy. I'm trying to give you the framework of how to think, because the question isn't which asset will rise the most in X amount of years. The question is which combination of investments will give me the best risk-adjusted returns for my specific situation, in this case, your specific situation. And then some general notes before we close. So returns is what you see. These are the flashy numbers, but the volatility, the drawdowns, are what you actually feel and what you have to live through and, so to speak, withstand. Inflation is a silent tax, and you cannot discount it when looking at investments. And genuinely uncorrelated investments reduce portfolio variance without sacrificing returns. However, genuinely uncorrelated investments are pretty hard to come by. Right, and that was it for this video. I really hope you enjoyed. You can check out the simulator yourself on my GitHub profile. I'll put the link in the description. Just download the HTML file, inspect it if you want. You can just inspect the HTML source code with any AI that you want, for example, and just open it in any modern browser and it should work. And also remember, this is not financial advice. I don't advise you to buy any specific asset or sell any specific asset for that matter. And these are all modeled on historical assumptions or assumptions made from historical data. So this does not say anything whatsoever about the future, and always do your own research. And also, before I forget it, inflation was modeled deterministically here at 3% per year. So it does not change per year how it does in real life. That's good to know. All right. Thank you so much for watching. Hit the like button, smash the subscribe button, and hit the bell. And comment down below what you want me to make videos on in the future. What other stuff is interesting to you. I can do more of these visualizations or code examples, whatever you want. Let me know down in the comments, and thanks so much for watching.